Let's get back to the market. Q4 earnings season finally over, and it has been better than a lot of subdued expectations. So let's discuss this and more with Gautam Duggad of Motilal Oswal Financial Services. Gautam, always a pleasure to have you on the shows. I've got your note open in front of me. It says earnings review, fourth quarter FY25, beyond the benchmark, a surprise surge. So that's a pleasant headline to start with. But I must place on record here, because now that you've done the numbers, we ended FY25 with Nifty earnings growth of 1%, right? 1%. That's, I mean, we always knew it was a bad year, but that's still shocking. So 1% se to upar acha hi hoga. Definitely we're going to be much better this in FY26, right? But your thoughts on this earnings recovery that everyone's anticipating?
Yeah, good morning, Subi. Thanks for having me here. So look, FY25 ended on a flattish note for Nifty as well as the broader markets. The 1% EPS growth basically is a 4 to 5% profit growth. There is obviously a free float related factor adjustment depending on which company has driven the earnings. But suffice to say that FY25 was a flat year. And this year has come after 4 massive years of 24% earnings CAGR between FY20 to 24. Right, for the broader markets and close to 20% for Nifty. There were many factors, obviously, as we all know. We've seen that in the first 9 months. This quarter, the bigger news is not just Nifty, but beyond Nifty, which is why we wrote beyond benchmark. So, for example, if you look at the mid-cap coverage universe that we have of close to 90 stocks, the earnings growth is 19%, right? Large cap growth is 10%. My broader coverage universe of 300 stock, the earnings growth is 10%. And it's not led by one sector or two sectors. So there are 19 sectors which have delivered numbers which are either in line or better than expectations. Only 3 sectors have missed expectations. They are very small. Second, the breadth of the earnings has been fairly good. 74 to 75% of the coverage companies have delivered numbers which are either in line or better than expectations. This number usually is 64, 65%. So clearly, sequentially, we have seen better bottoms-up performance. Third, the upgrade to downgrade ratio has improved massively. The upgrade to downgrade was just 0.3x. This quarter it is 0.6x, right? While we have seen downgrades in FY26 for Nifty by close to 2.5%, but we are still expecting about 12 to 14% earnings growth next year. Now, obviously, the spread of the sectors will change, but this quarter has been fairly good. When we spoke at the time of preview, I would not have imagined that we will grow 10-11% this quarter. And that's why I highlighted that this is not led by one or two sectors. Multiple sectors have done well and beaten expectations.
Gautam, just checking, Gautam, just rechecking that number, 19% was the earnings growth of your mid-cap coverage universe in Q4, right?
Yes. So 89.
Yeah, that's a good number. So I was just double checking on that. Got it.
Yeah. So 81 companies we cover in the mid-cap domain as per SEBI classification. For those 89 companies, we were expecting a growth of 9.6%. The actual delivery is 19%. And even if you exclude commodities, the growth is close to 15% for mid-caps. However, the bad news is that small caps struggled. So small caps, we cover about 122 small caps. For those 122 small caps, the earnings growth, earnings decline was 16%. Entirely led by financials because there were a lot of MFI and some of the NBFC small cap companies which posted bad numbers. Excluding financials, also small cap numbers were flattish. So whichever way you slice or dice, small caps underperform, mid caps perform very well, and large caps perform in a very steady 10% kind of a growth fashion.
All right. Hi, Gautam. Good to hear your thoughts, and I was happy to read your note as well on Sunday night. Now, I want to ask you a couple of questions. You all are working with the 12% Nifty EPS growth for FY26. What's the downside risk to that? Because normally I see, even in the last year, a lot of brokerage firms, not just yours, started off with higher expectations and gradually that graph came down and we ended up with only 1%. And Surabhi sounding very optimistic. She's saying that this year though is going to be very good. What's the downside risk to that 12% earnings growth that we're working with?
So let me first speak for all the brokerages because in FY25, it was the first year where we had to cut by such a big magnitude. And this was the first year where earnings got downgraded by double digits. FY21-22, we had upgraded estimates throughout the year. FY23 was very steady. We didn't cut, neither we upgraded. FY24, again, there was a 2 to 3% upgrade from where we began with. So, while it does give the impression that brokerages are always starting with a higher numbers and then they come through the year, but the record is slightly different. 4 years, there was no number cut. FY25, therefore, is the first year in 5 years when numbers got cut by a big extent. As regards your question on what can go wrong and what can lead to downside in FY26, Nigel, see, we are living in a very volatile environment, especially globally. So commodities, obviously, while they do not have significant weightages in the indices, but their weightage in profit pool is massive. So, for example, if you look at Nifty 50 profits, in Nifty 50, commodities are roughly 20-25%, metals and oil and gas. And that's a number which keeps on changing every quarter depending on the underlying commodity prices. Plus, it also gets impacted by a lot of global factors. So that's a number where we usually don't have a very strong handle. We take it as it comes and mark to market it. Aside of that, I think 10 to 12% earnings growth doesn't look difficult. While the sectoral mix may change as we move forward, we might expect some sector to do well and something not to do well. It can interchange during the year. But 10 to 12% growth doesn't look that difficult to me at this stage if you're able to print a nominal GDP close to 9 to 10%. Right. Plus, you have income tax cuts, you have rate cuts which are happening. CapEx peaked up to March number was massive, 2.4 trillion. Come to think of it, that CapEx number of 2.4 trillion in March was our annual number in FY15. And whatever we've done in a quarter in 4Q FY25, the CapEx number was a full year number in FY20. So we've come a long way on CapEx. Obviously, this thing happens slowly. We tend to forget and appreciate the impact that it creates over a period of time. But I think CapEx should look slightly better as we move forward in FY26. So 10% is what you should move with or work with.
10 to 12%.
Yeah.
10 to 12% full year earnings growth, FY26 for the Nifty.
Yeah. And then, of course, you have a hard work to do, which is to identify bottom-up ideas.
I was going to ask you to do that hard work. I mean, now tell us, which are the horses to bet on? Kaun se ghode jaldi bhagne wale hai, as they say, in this earnings race?
Yeah. So, Surbhi, look, we've had a very positive view on few of the sectors, which fortunately has turned up quite well. For example, the financials, where we timely made the switch from underweight to overweight back in October. That has worked exceedingly well. If you look at the returns this year, calendar year 25 YTD, first 5 months, the banking index is up close to 10 to 11%, and IT index is down 14%, which is where we had cut weight in January. Now, it's our thesis since last many years, and we had put out 2 big notes on this a couple of years back, that in any given year, banks and IT do not outperform together. The only exception was CY17. Otherwise, job is slightly easier if you are able to pick between the two. And this year, we made that choice of picking banks over IT. So far, it is turning out well. There is a 25% outperformance by banks over IT. Not that we do not like IT. IT also is reasonably priced now, especially the large caps. But our overwhelming preference is for financials. And within financials, it is non-banks and non-lending NBFCs. So capital markets, there is preponderance of capital market plays in our model portfolio. So we like BSE, we like Angel, which is our 40% in the last 2 months. We like HDFC, AMC, Nuvama. In NBFCs, we prefer Shriram. And of course, in banks, we have Kotak Bank, ICICI, and HDFC. So banking is a big pack for us right now. Second, we like consumer discretionary, which has been the overweight stance for the last 3-4 years now. And it seems that consumer discretionary results this quarter were far better than expectation across multiple subcategories: jewelry, apparel, even footwear to an extent, and then QSR. And then we like industrials, we like telecom, we like pharmaceuticals. And incrementally, we are finding auto slightly better position. Now, we've been underweight on auto for a year, but given the current, risk reward, I think auto is looking attractive again. The expectations are very modest in auto, and valuations have corrected a fair bit there. So that is now looking like a stance that we might have to rethink.
Okay, interesting. Yeah, are we at some sort of an inflection point for the auto sector? Interesting thought to wind up the discussion on, and we'll probably, dwell on that in the coming chats as well. Thank you very much, Gautam. Always a pleasure speaking with you. Thanks for joining us.
Thank you.
Thank you.